Hello guys, welcome back to my channel. So today I will be starting the new chapter and the new standard, that is class 12th, and accountancy, accounting for partnership forms. So this is the fundamental that I want to clear. Now let's look into the partnership. Let's learn. So partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. I hope that you have studied the partnership, one of the organization, one of the form of business that you have learned in business studies class 11. The second chapter, the joint stock company, partnership, HUF, and cooperative societies, sole proprietorship. So sole proprietorship is the one that we have studied in the class 11, that how to prepare P&L, balance sheet, and the trading account for the sole proprietor. Now this is the grade 12th, in which we have to study the partnership. Now main features or essential elements or characteristics of partnership are two or more persons. So there must be at least two persons to form a partnership, and such persons must be competent to contract. Now as per the Indian Contract Act 1872, every person except the following are competent to contract. First of all, minor, persons of unsound mind, and persons disqualified by any law. Maximum number of partners. Partnership Act does not specify the maximum number of partners, but the central government has prescribed maximum number of partners in a firm to be 50, Wide Rule 10 of the Companies Miscellaneous Rules 2014. Now, what are the rights of a partner? Every partner has the right to share profit or losses with the other partners in the agreed ratio. Every partner has the right to take part in conduct of the business. Every partner has the right to inspect and have a copy of the books of accounts. Every partner has the right to be consulted in the matters related to the partnership business. If a partner has given loan to the firm, he has the right to receive interest at the agreed rate. If the rate of interest is not agreed, then it is paid 6% per annum. Now, if a partner incurs expense or makes payment on behalf of the firm, he has a right to be indemnified by the firm. Every partner has a right to retire from the firm after giving a proper notice. Every partner has a right to disallow the admission of a new partner. Every partner is the joint owner of the partnership property. Now let's talk about the partnership deed. Since partnership is the outcome of an agreement, it is essential that there must be some terms and conditions agreed upon by all the partners. Such terms and conditions may be either oral or written. The law does not make it compulsory to have a written agreement. However, in order to avoid all misunderstandings and disputes, it is always the best course to have a written agreement duly signed and registered under the Act. Now, such a written document which contains the terms of agreement or terms and condition of everything is called partnership deed. It is also called articles of partnership. The partnership deed should contain the following points: the name and the address of the firm, names and addresses of the partner, the type and nature of the business the firm purposes to do, amount of capital to be contributed by the each partner, or whether we have to tell the accounts, whether the capital accounts are the fixed or the fluctuating. Fifth is interest on capitals, whether interest is to be allowed on partners. If so, the rate of interest क्या होना चाहिए. Now talking about drawings, how much amount the partners are entitled to withdraw for the personal use, है ना. Sorry, it was drawing. Now interest on drawings की बात करते हैं, whether interest will be charged on partners drawings. If so, the rate of interest. The profit sharing ratio, है ना, the ratio in which the profit and losses are divided among the partner. The salary, है ना. The 10th is goodwill, method of valuation of goodwill in case of admission or retirement of a partner. Accounting period of the firm. If the partnership deed is not there, in the absence of partnership deed, Partnership Act 1932 is applicable or will be applicable. First, profit sharing ratio. Profit and losses are to be shared equally irrespective of their capital contribution. Profit and losses are to be shared equally, and in the partnership deed it is already agreed by all the partners that in this ratio they will be sharing profit and losses. Now the second is interest on capital. No interest on capital shall be allowed to the partners. If there is a provision for the interest on capitals in the partnership deed, it will be allowed only when there is a profit. If there is a profit, then and then only interest on capital will be allowed to the partners. But in the partnership deed, it is not there. it is already agreed that in that 6% or 8% is there, is the rate of interest on capitals according to their capitals contributed. Now the third is IOD, no interest is to be charged on drawings. And while in the partnership deed it is already agreed that to which interest rate we have to be, the firm charge the drawings IOD. Now fourth is salary to a partner, no partner is entitled to any salary or commission for taking part in the running firm's business. While in the partnership deed salary to a partner is there, means it is already agreed, or it is already made the agreement by the partners ki according to their work they will entitled to get a salary of this and this, commission of this and this rupees, or this and this. Now the fifth is interest on loan, interest at the rate of 6% per annum is to be allowed on a partner's loan to the firm. Such interest shall be paid even when there are losses to the firm. So interest on loan means interest at the rate of 6% is to be allowed on a partner's loan to the firm. Now sixth is admission of a new partner without the consent of all existing partners. No new partner can be admitted to the firm. So the thing is that when the deed is there, deed applies, deed plus profit should be there, then and then only the firm will provide interest on capital, salary, commission to the partners. Now the thing is that when there is no deed, the Partnership Act of 1932 applies. So in this, no salary, IOC, commission shall be allowed or provided to the partners, or if there is any profit or ratio, if there is not agreed ratio, then the P&L ratio will be equally, profit and losses would be equally shared by the partners. Talking about interest on loan given by partner to the firm, so it will be 6% per annum, means it is compulsory to give even the firm is in the loss. Talking about income for the firm, so interest on drawings will be charged from the partners, interest on loan given by firm to partner, so it will be compulsory when the deed is there.